Hello, everyone, and welcome to the mid-year market and retirement planning update. Today's date is July 8th. After the 4th of July Independence holiday last week, we are back in the office, ready to get this out to all of you. So we're a few days behind where we normally would get this out, but I think everyone will give us a little leniency with that. So in this quarter's commentary, what we want to spend some of our time talking about is really what's happening in the markets. I would likely be remiss to say if many of you were sitting in our office or having a conversation about the stock market towards year end, the outlook, the perspective, or just the overall exuberance and excitement around that probably wouldn't be where it is today. When we look back at the numbers of performance and returns, really across almost all asset classes year to date, it's very encouraging. Most of us have seen significant gains in our accounts, and we're above the previous highs of last year. And so it's a very, very positive outlook. So again, what we're going to talk about today is just sort of some general returns and where the market is at. We'll talk a little bit about some of the things you may be reading, hearing, listening to, things that are being published around maybe what could go wrong in the markets or some things to be worried about. And again, to be very candid and clear, there's always some things out there that could be wrong. And if there's nothing, then that's usually the time to be very cautious or nervous. When we look at the returns year to date, you can see very clearly that really across the board on the equity side, we're seeing double-digit plus returns. S&P is up over 20% year to date. The Dow Jones up over 16%. And even when we go in to look in the international markets, like developed, international, and emerging markets, you can see those at around 11 to 15%. Very, very positive, very, very encouraging. Now, when we go down to the fixed income side of things, so again, the offset really to our equity portfolio, you can see that they have made significant strides and are doing everything that we would hope that they would do for us. You can see really between core bonds and high yields, we're seeing returns between 6 and 10%. So for that person who's a more aggressive investor, you should be seeing mid to high teens returns year to date. And for that person that's maybe a little bit more balanced, you should also see something maybe in that 12 to 14% rate of return range, depending on your risk tolerance. So very, very positive, very, very encouraging. Most of us should feel very good about where we're at year to date. So one of the things we constantly see out in the marketplace when we're reading or looking at data is that the market is overvalued or undervalued or this metric or that metric. Well, there's a few key metrics that we tend to pay close attention to, the primary one being the price to earnings ratio. And as you can see here on this particular chart, you can see that we're just barely in the range of overvalued relative to historical 25-year average. Now, one could say that the market may be slightly overvalued because earnings are really strong, growth rates continue to be strong, but overall, when you look at all the different metrics, the market really is not that much overvalued relative to historical measures. Again, to talk about volatility, now interestingly, over the last really 190 years, call it, the S&P 500 has been tracked. The market has been positive 85% of the time. When we look at the last 50 years, the market has been positive 75% of the time. So even though the market is up 3 out of 4 years, the one thing that is for certain is that there are always market corrections, even in those positive up years. That you can see with the red line here. So part of this is for me just to remind and ingrain all of you that market volatility always exists. Even years like this year when we're up 17 to 20%, we still experienced a 7% correction in there. Last year we experienced a 20% correction, and those happen every couple of years too. So volatility exists even though overall the markets are very, very strong. So one of the probably more primary talking points that we're seeing out in different articles and publications that is making the news is really where we're at with interest rates. So a few months ago, the yield curve inverted, and what that essentially means is shorter term rates are now higher than longer term rates. So in a traditional viewpoint of interest rates is that the further out the maturity or the expiration date is, typically that rate tends to be higher. When the shorter term rates are higher than the longer term rates, that means people are selling those longer term bonds or notes and they're moving their money into shorter term notes. So they're essentially saying, hey, we want to be safer more in the short term. Usually this is a sign or a predictive indicator of a recession. Now, to contradict myself is that typically what we see is that that recession is not imminent. It typically ends up being somewhere between 6 months and 4 years later. So it really is, although kind of precedes a recession, it's really not a very good indicator of when it's going to happen. So in theory, this could go on and on and on, and the market could continue to do well. If you were someone that sold out or exited the markets right after the yield curve inversion, you would have missed out on this last leg of returns that we all received in the market. Additionally, with the economic health we're seeing out there, 224,000 jobs were added last month. The unemployment rate is at 3.7%, and wage growth is continuing to increase at 3.4%. These are signs of a healthy, strong economy, one where typically we're not seeing recessions, and we're also not seeing the potential for interest rate decreases. So we've heard a lot of President Trump talking about how the Federal Reserve has not been doing a good job or how they should cut interest rates. You know, these are part of the reasons why there needs to be some separation between the Federal Reserve and the executive branch, because ultimately, no matter what president is in office, they're going to want to see the market thrive under their term, and this is what he is posturing for here. But the reality is their job is to look at things longer term, not just the interim, and try to provide a very balanced environment for the economy to grow and thrive. So with that being said, I'm going to keep this quarterly video short, brief, and positive. The markets have continued to recover quickly and strong and swiftly. Every correction seems to be met with a lot of buying and forward upward movement after the fact. So this leads for us to stick to our asset allocation model, stick to our strategy, being patient, rebalancing, doing the things that we do regularly for people like yourself. Unemployment is low. The consumer is healthy. We're seeing lots of cranes and buildings being built through all the metropolitan areas of our country. Those, again, continue to be signs of a good economy. Now, I remind you, the economy is never perfect. The markets are never perfect. They never were meant to be that way, and they never are. So we encourage you all to remain long-term focused. If you have questions, concerns, please reach out to us. We're here for you. With that, enjoy the rest of 2019.